This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So we had a good episode today where we talked about the biggest topic, I think, was the CPPIB and the report that came out saying, hey, look, active management is good. So we talked a lot about that, but also talked about value stocks, talked about when to take CPP, so two CPP topics.
And a little bit on the MD management takeover by Scotiabank and what they're doing to lower fees and bring more management in-house. So 4 good topics.
This is our 52nd episode, which as we noted in the episode, takes us to a year of the podcast.
So happy anniversary and hope you keep listening.
Welcome to episode 52 of the Rational Reminder Podcast. That's 52 weeks. That's 1 year.
And a long... Actually, it hasn't been a long ride. It's a remarkably short ride, but yeah, 52 episodes done.
That's our 1 year first anniversary of the podcast.
And you can tell we're very well prepared for the anniversary celebration. Anyway, topics today, we got to kick it off with a good one here. I know it's pretty near and dear to your heart.
You always say that. I think that a lot of people were pretty fired up about this one. The CPP performance analysis that the PBO, the Parliamentary Budget Office, put out, arguing or demonstrating, whatever you want to call it, that the CPPIBs, that's the CPP, Canada Pension Plan Investment Board, this report is showing that their active management strategy, which started in 2006, has added value. It's done better than CPPIB would have done if they just continued indexing, which is what they were doing before 2006.
And they've been the punching bag of Andrew Coyne in lots of articles over the past couple of years in the National Post, just hammering away at them because they used to be very low cost, largely, I think, passive index strategy before then at hardly any cost whatsoever. And over the past, 12 years, they've really ramped up cost and exposure to different asset classes.
Yeah, their expenses have gone up orders of magnitude, and they've gotten into more exotic asset classes like investing directly in private businesses, directly investing in real estate, in addition to public equities. So anyway, this report came out. Apparently there was, I can't remember what it said, parliamentary interest or something. The people were interested.
That's what I was wondering. Is this a regular report or is this a one-off report?
No, it said in the report that it was due to some sort of political interest that I guess someone had asked for it to be done. But anyway, we read the report and found some issues.
And a lot of our friends online found issues. I know Preet Banerjee was quite vocal online about it.
Yeah. So what they did, and it's a little bit hard to work backwards and figure out exactly how they did the calculations because it included all the contributions, which I don't have that data. So I can't go and rerun exactly the analysis that they completed. But the way that they explained it was, this is how much in dollar terms the CPP fund is worth. And this is how much it would have been worth if they'd used passive management instead. Right. So that's how they ran the comparison. And one of the things they did that was kind of a red flag in my mind was that to do the comparison, they assumed the same operational expenses for the index strategy and for the active strategy.
So what do you mean by that?
The CPPIB's fee, whatever you want to call it, their costs are 84 basis points. I think it's 84. And from the wording in the report, it looks like they used 84 basis points also for the index strategy.
So to make the argument that fees really aren't an issue, we're taking fees off the table by making it the same in both. But in reality, on the index side, it's much, much cheaper.
Yeah. I mean,
70 basis points, 80 basis points cheaper.
Yeah, exactly. That was something where I kind of raised an eyebrow. But that's not even the biggest issue, not even close.
So what's the biggest issue? The asset?
Well, the biggest issue is
comparisons?
Yeah. So they take CPP.
And that's that small print that you showed me.
Yeah. Well, the small print, I don't know if I wrote that down. Do you have that small print written down?
Well, just the 70-30 comparison portfolio.
Yeah, but the small print was, the wording there was interesting. I should pull that up. But while I'm pulling that up, I can still talk about the biggest issue. So the biggest issue was they compared the CPP portfolio, which has an asset allocation.
I've got it here. So the asset mix on the CPPIB is 8.5% infrastructure, 9.1% credit investments, 10% government bonds, cash and absolute return strategies, 12% in real estate, just over 3% in other real assets, 33% in public equities. So only a third of the portfolio was public equities, and just under 24% in private equities.
So that's a pretty exotic asset allocation. And in this report, in this PBO report, they compared it to a 70-30, 70 global equities, 30 public equities, 30% Canadian nominal bonds. And they actually did 3 different comparisons. They said, here's how it would have looked if the index portfolio was 55% equity. Here's what it would have looked at 70%, and here's what it would have looked like at 85%. Now, they used 70% as like the main comparison in the report, but they did show some sort of tolerances around what if it was a little bit more aggressive for the index fund, what if it was a little bit more conservative.
So you read this and flags are going up. So tell us what sort of decision you decided to go make your analysis on.
Well, I went into Morningstar Direct and tried to dig up indexes for each of the asset classes. Because if you're benchmarking, you can't benchmark one portfolio that consists of a bunch of different asset classes to a portfolio that consists of more different asset classes. Right. Like the overlap in terms of asset classes is pretty small between a 70-30 stock bond portfolio and the CPP portfolio.
Okay, so you built up what you would say is a more risk appropriate type benchmark to compare it to.
Yeah, so I went and dug up, I found I did 10% FTSE Global Core Infrastructure because there's infrastructure in the CPPIB portfolio, 10% Bloomberg Barclays Aggregate Credit, 10% FTSE Canada All Government Bond, 13% S&P Developed REIT, 33% S&P Global Large Mid, which is the same public equity index that they used in their report, and 24% LPX Composite Total Return. LPX is an index provider for private equity. Now they're doing listed private equity companies, the LPX index, but the index has been designed to be a representation of private equity.
So would these be better diversified than the CPP portfolio, do you think? Any sense of the numbers?
Who knows? And that's secondary, right? Like it's like we just need to know, okay, so CPP is investing actively in these various asset classes. How would they have done if they had just held the indexes? And I can't even look at that because I don't have enough data on CPP's performance to say here's how my index portfolio did, how did they do? But what I did do is just took their 70-30 reference portfolio that they used in this report to compare to CPP's performance, ran the performance numbers on that from June 2006 through March 2019, which is when this report spanned.
Yep.
And then I compared that to my risk-appropriate index portfolio.
And do tell, what did you find?
Well, the risk-appropriate portfolio that I created, it had very similar performance to the 70-30 portfolio, like nearly identical. It was off by 18 basis points, I think. Yep. But, and this is the big but, and this is the whole basis of the issue of how they did this benchmarking, the standard deviation, the volatility for my risk-appropriate portfolio was much higher. So you get similar returns from the risk-appropriate fancy index portfolio relative to the plain vanilla 70-30 portfolio. Similar returns, but the fancier index portfolio had much higher standard deviation.
So at the surface, it looks like CPP, it's good. Similar returns, lower volatility, that's a good thing.
But it's not lower volatility. That's what I'm saying. It's higher volatility for my index portfolio. I don't have volatility data for CPP.
Oh, I get you now. I thought you're saying that it had lower.
So assuming that CPP's assuming that volatility is a good measure for risk, and assuming that CPPIB's volatility is similar to my index portfolio, then if those things are true, then this is a riskier portfolio, which you would expect. Like when you look at what CPP is holding, they've got the infrastructure, they've got the private equity, they've got the direct real estate. Those are all relatively volatile and illiquid asset classes, so they have more risk. Now that's the core of the issue. So CPP is comparing a relatively liquid and safe 70-30 traditional stock bond portfolio to a much riskier in different ways portfolio that has all these exotic asset classes in it. So what I did then was said, okay, well, what if, I wrote down the performance numbers. I didn't think I had them. So for my risk appropriate benchmark, that's the one where I used all these fancy indexes.
Yep.
The annualized return over the report period was 6.86%. The 70-30 benchmark, 6.68%. So it trailed. Yep. So adding all these exotic asset classes
There's your 18 basis points. Yep.
Right. And now CPP the PBO in their report showed that the CPP portfolio outperformed by 1.2% per year on average. So even based on this, it looks like they beat their risk appropriate benchmark.
And these are before or after fees?
My index thing is before. There are no fees taken off. CPP's performance was reported net of net of fees. So, like I said before, we have these similar performances for the fancier benchmark and the regular benchmark, somewhat in line with the numbers in the report. But then we look at the standard deviation. Standard deviation for my risk appropriate benchmark is 11%, whereas the 70-30 portfolio is 8.08%. So I said, okay, how far can I push my equity exposure so that the standard deviation matches that of my risk appropriate benchmark for CPPIB?
Fascinating.
So I could go all the way up to 100% equity of stocks, which is like a 100% equity index. So 7.36% then becomes the annualized return with a standard deviation of 11.18% compared to 11.01 for the CPP benchmark that I created.
Wow.
So to get the same level of, now again, we're assuming that volatility is a good measure for risk, and we're assuming that the indexes that I've used for private equity and real estate and those things are properly capturing the volatility of those asset classes. But if that stuff is true, then in terms of volatility, we could have had just a much more aggressive equity portfolio with a similar amount of risk as measured by standard deviation, which resulted in, over this time period, a substantially higher return.
And arguably more liquidity.
More liquidity.
More mark to market.
Yep.
And for a portfolio like the CPPIB that really has a lifetime horizon,
and that's
infinite time horizon.
And that's part of their argument. Part of CPPIB's argument is that they have this extremely long or infinite time horizon, which is why they're investing in these illiquid asset classes. And sure, maybe there is an illiquidity premium, but
it costs dearly to get it.
And it's not cheap. It's not cheap. So anyway, based on this brief analysis, and I'm no expert in benchmarking or performance attribution or anything like that, that's a whole science on its own. But based on these numbers, and if we're measuring risk as volatility, which like liquidity probably isn't captured in there, I guess it depends how the assets are valued. That's the interesting about the NPX index that I use, or LPX index that I used. It's tracking listed private equity companies. So you'd think that it would capture the risk as volatility fairly well because they're publicly listed private equity firms. So the volatility, liquidity aside and valuation aside, the market should be capturing the risk of those securities.
But do you think it's a little disingenuous to compare the portfolio to a simple 70-30 index portfolio?
I don't know if it's disingenuous or if it's misguided, but I think the big issue that I have with it is that I had a couple questions from people this week saying, well, are you sure that indexing is still the right way to go? Because it looks like CPP is beating the market.
Because that was the headline that was picked up by the outlets.
Yeah. And that's no good. Like going and telling people, well, look, active management does work. Meanwhile, the benchmarking is, in my opinion, way, way off. And when you correct for the asset class exposures, at least based on this time period, you would have been better off just with a more aggressive portfolio of equities. So yeah, disingenuous, I would say that's a good way to describe it. And the other thing, and Andrew Coyne pointed this out in his article, the other thing is that even if, assume there was alpha over this time period, and CPPIB really did outperform a risk-appropriate benchmark. Even if that's true, the data on active managers' ability to continue to outperform once they've outperformed is horrendous.
And perhaps even more so with such a huge portfolio like this. It must get harder and harder to find investments that can have a meaningful impact on that portfolio.
And maybe that's why they're going into private markets. I mean, I would assume that the people running CPPIB are smarter than us. I would assume that they're managing a pretty big portfolio, but you can't argue with the data. So, I mean, and the other thing, just to cap off this discussion, the other thing that's always interesting to look at is the Nakubo report, which we've talked about a while ago on the podcast. And you look at the 10-year performance of all U.S. So Nakubo is I can't remember what
National Association of College and University Business Officers.
There you go. So it's endowments for colleges and universities in the States, and they report their performance, and Nakubo presents that in a report. So their 10-year performance on average was 5.8%. And then you go and look at the largest institutions, so that's assets over 1 billion. They've got 58% in alternatives. So that's private equity, venture capital, direct real estate, all that fancy stuff like CPP has.
And I think a simple 60-40 index beat the vast majority of them, right?
It was, so yes, 60-40 portfolio did beat them. But then the interesting thing that I pulled out of the Nakubo report is that if you looked at the smallest, so the smallest endowments with less than 25 million, they've got only 11% in alternatives. And their average return was only a couple of basis points lower. So even within I agree, over this time period, as ending 2018, a 60-40 portfolio, I didn't run the numbers on it, but I believe a 60-40 portfolio did as good as, if not a little bit better than those numbers. But the thing I found interesting was those larger endowments that are all loaded up with all the private fancy stuff barely did any better than the smaller endowments with less of that. So anyway, I think that report, I think it was irresponsible. I think it was irresponsible to put that out there because it now makes Canadians think that active management is...
And that's the main takeaway. I mean, you got to question articles like that and headlines like that and dig into the details.
Now, CPP, to its credit, or CPPIB, is extremely well capitalized, and it is globally regarded as one of the largest and best run pension funds in the world. So maybe what do we know? But
it's worth it to bring up this debate, inform people.
Yeah. And I would love it if they follow up with another version of this report that does some risk appropriate benchmarking or some more... I'd
love to have someone from there as a guest.
More detailed performance attribution or something like that.
On to current topic number 2.
Yep.
This one, I've called it was only a matter of time. So last October, MD Financial announced that it was being taken over by Scotiabank. So it was a huge transaction. I think they paid over $2 billion for almost $50 billion of assets over at MD Financial. So MD is a organization that provides financial services to doctors and their families. So we have a number of doctors that have had experience at MD Financial. And this is a headline I caught this morning in one of the feeds that we get. So on June 13th, MD announced, and I quote, a realignment of portfolio management responsibilities for a number of the MD funds and pools. So basically they are, again, I'm quoting, leveraging their relationship with Scotiabank to reduce annual investment fees by approximately $6 million. That's a great, great headline. And I'm not saying that this is necessarily a bad thing, but what they have done is they've shifted some of the asset managers away from the managers that were there before over to managers that are owned by, of course, Scotiabank. So one of them that was added in was Jarislowsky Fraser, which is a firm. That was another big headline just over a year ago. So Scotiabank acquired Jarislowsky Fraser in May of last year, and then they rebranded their own Scotia Asset Management a number of years ago to what's called 1832 Asset Management. So that was the year that Scotiabank was founded. So again, it may not be a big deal, and it may be in the client's best interest, but it's not surprising to see a bank kind of go vertically integrated to a greater scale on their products that are used in the MD pools.
But like you said, it's no surprise. I mean, Scotia didn't pay that kind of multiple for MD's assets without expecting some sort of synergies with their existing business. That's why these acquisitions happen in this space.
I think that's why a lot of the doctors that we know were less than pleased with how the whole thing went down, because they kind of thought it was in the doctor's best interest having this organization, but maybe this transaction ended up not being. Maybe. I don't know.
Well, I think if nothing else, the transaction highlighted for a lot of physicians that, hey, wait a sec, these guys weren't actually sort of for doctors by doctors. This is a business. And I think more and more doctors over time have realized that MD is a financial institution like any other, selling financial products to make money.
Did you notice on the chart the amount that the expense ratios fell by?
I didn't look.
So most of them, vast majority of the ones fell by 1 basis point.
Big savings.
A few fell by between 2 and 5 basis points, and one fell by 10 basis points. But one thing I went on the website this morning to see, because I've always wondered, why has MD not really embraced evidence-based investing and indexing? I mean, doctors, their decisions are based on evidence, so it would be a natural fit for them to go indexing, which they haven't done in a big way. However, there is a big button on their website right now, and they offer the MD Precision Index Portfolios. I hadn't seen this before, and it's offered through MD XO or EXO Direct, which I assume is their robo offering.
It is, yeah.
It looks pretty slick, good-looking platform, and good-looking portfolios, but it's certainly not the dominant pitch on their webpage.
Yeah, well, they rolled out last year. They did partnership with Q-Trade, I believe, where they rolled out discount brokerage platform through MD, and they also rolled out the XO service through MD. They rolled out a bunch of different services last year, and they kind of segmented their clients differently starting last year. But the XO was their part of that, so they pushed younger doctors toward that robo platform.
Anyways, so portfolio topic: does value still make sense? So this is a question that's come up quite a bit, certainly in our circles. A few clients have asked about it, I think.
Well, you look at the performance of value relative to growth over the last decade, and it's been pretty bad. in the US, 10-year value premium has been annualized, so per year, minus 3.29%. So that's growth stocks have beaten value stocks by 3.29% per year on average for the last decade.
Yeah, so it's not compared to the market. It's comparing growth to value.
Right.
So it's the two ends, the barbells of the market.
But then you look at the last 3 years and that performance difference, so the amount that growth has beaten value in the US, per year, 7.24%. Those are big numbers. Yeah. Annualized 7.24% over 3 years. That starts to be serious money. And then the EFI, the Europe Asia Far East Index, has had a minus 2.75% premium for value for the last decade. So that's value trailing growth by 2.75% per year on average for the last decade in international developed markets. Canada value's actually been pretty good over the last decade. It's been positive 3.19% value over growth. So in Canada, we've been a little bit insulated from the death of the value premium. And I say that in jest, the value premium is not actually dead. And we're going to talk more about that in a sec. But I mean, that type of underperformance for 3 years, that's ugly. So
especially compared to a broad index, for example, that'll be heavily growth weighted.
Right. So you look at like our portfolios are value tilted. And a lot of investors in general who are following the evidence anyway will tilt their portfolios toward value. But that's really hurt. And that's part of the story of value, and that's part of the risk.
Well, it's hurt. I mean, returns have still been good.
Relatively speaking, though, not so good. And especially when you have all the hype around the FANG companies.
Well, I agree 100%, but it's not like the returns have been negative. It's just the delta has been negative.
Right. But you eat the delta. It's an economic cost. Anyway, so when we look at the U.S. stock market, which is where we have the most data, so it's the richest place to look, going back to 1929, which is when most of the easy to access data starts, there have been 10 historical 10-year periods. So since 1929 till now.
So rolling.
Well, I think I wrote down did I write down the periods? No, I didn't.
So 10 historical decades going back to 1929 where value trailed growth.
It was rolling periods, but I looked at the decades. They weren't overlapping.
Okay.
They were not overlapping. So that's 10 independent decades where value trailed growth. So, I mean, where we are now, this 10 years of underperformance, that can happen. And it has happened on multiple occasions. Not that often.
And we tell people all the time that this likely will happen.
Oh, it absolutely will happen. If there was no expectation that periods like this would happen, then there would be no premium.
Correct. So the big question is, no one really disputes that there is a value premium. It's what is causing this, right? And will it persist?
Well, that is a big question. So like you said, there's no question that there has been a value premium. Like I listed I should have done the data for all the way back. When you go back as far as we have data for any geographic region, the premium for value has been positive, meaningfully positive. I wish I pulled those numbers, but like as negative as it's been now, it's been that positive in the rest of the data set. Just this one decade that we're in, value has not been so attractive. So there's no dispute, there's no disagreement. No one's saying that the value premium doesn't exist. But the big question is, does it exist because value stocks are riskier? Or does it exist because people misprice growth stocks or misprice stocks in general? And the reason that matters is that if the value premium is a risk premium, it should persist. If it's a risk that's priced into stocks, then it should persist. There should be a premium in excess of the market going forward. However, if it's a behavioral phenomenon, it's not so obvious that it's going to persist.
Do people get smarter and how they trade, therefore it might just go away?
If it's a behavioral error and people get smarter and realize that it's an error, then it can go away. It can be arbitraged away. But if it's a risk premium, you can't arbitrage away a risk premium, so we would expect it to persist. And especially in time periods like we're in now, where there's been this extended period of underperformance for value, that question becomes really important. Is it a risk-based premium or is it a behavioral premium? We dug up not all the research. That would be I'd be overreaching if I said it was all the research because this has been researched extensively, but I dug up a pretty broad selection of the core research on this topic of this behavioral or is it risk-based?
So we'll go through them, one by one, and then take away the key points of each?
Yeah, I figured they're put little short notes for each of them. So I think we can just go through. So the behavioral explanation in general terms is that investors overreact to the growth potential of growth stocks and also overreact to the lack of growth of value stocks. So if investors are overreacting to the expected growth of growth stocks, then we would expect the prices to mean revert, to come down.
They overlove and overhate. When
Right.
they realize that the love isn't justified, they dump it.
Correct.
Right? And the ones they hate, they really don't like at all, they drive it down far too low.
Right. And so you would expect, if that's true, there to be some mean reversion. And that was, as far as I know, one of the first research papers that was done on this was done by Werner de Bont, who I've never heard of. Sorry, Werner. And Richard Thaler, who, maybe that's why I said that, because it's contrasting with Richard Thaler, who I have heard of. Most people probably have.
Nobel Prize winner.
And he's been sort of one of the fathers of behavioral economics. So anyway, they did this paper in 1985 where they were looking at this exact question. They looked at whether or not there is mean reversion in value and growth over the long term, which they were suggesting would support the existence of this overreaction. So they formed portfolios based on past stock returns, used that as the proxy for the hype factor. And what they found was stocks with low past returns did tend to have higher future returns. So they, in their paper, proved that there is this overreaction. Now, don't worry, there's more to come that disagrees with that, so that's 1985. And then in 1994, Lakonishok, Schleifer and Vishny, this is another very highly regarded paper in this space. Their hypothesis was that past earnings and sales growth are extrapolated too far into the future by investors, resulting in stocks with high sales growth being overvalued and stocks with low sales growth being undervalued. So that was that original suggestion that I talked about where you get that overreaction. So they did a paper and showed with their research that was in fact the case.
That investors do overreact. Correct. On both ends.
Correct. And so now we have these two metrics. So in the first 1985 paper from Thaler, we have the past stock returns as one sort of proxy for the overreaction and underreaction. And then in the Lakonishok paper, they presented past sales growth. So companies with high sales growth, that would be a proxy for the overreaction. So now we have these two behavioral factors that we can look at. So then in Fama and French in 1996, they looked at both of those past papers and a bunch of other papers. And they found, as you would expect Fama and French to find, that any differences in future returns that could be explained by sales or earnings growth, which is what Lakonishok looked at, or long-term reversal of returns, which is what Thaler looked at, they found that those things were equally explained by the size and value factors in the three-factor model.
Because they did this paper, 4 years after their seminal paper in 92, right?
Correct. So in Fama and French's paper, they said, okay, we see that you've done this research and that's fine, and we see the data, but the behavioral factors that you've proposed, they're not actually adding any explanatory power to the model. So if you use our three-factor model, your behavioral factors are not actually adding any value.
So market size and value explained it.
Correct. Now, the reason this gets really tricky, and it is tricky, is that both of those types of factors, the behavioral and the risk-based, so the Fama and the Thaler and the Lakonishok, all those different factors actually produce a similar value premium. So then the question, and this is a listener question that I had not too long ago by email. Someone asked, how do you know what the right explanation is? Like, they both produce similar premiums, so they're kind of interchangeable in terms of definition of value. So I could say that behavioral factors are a bad proxy for the risk-based factors, but you could equally say that the risk-based factors are a bad proxy for the behavioral factors. So what is the truth? So I found a 2014 paper by David Blitz, Bart Vander, and Matthias Hanauer.
You're on a first-name basis with Bart.
I'm not trying to be rude, I swear. That was a somewhat challenging name to pronounce. So they looked at global data, which most of these papers have looked at US data, but they looked at global data and they were setting out to test the overreaction hypothesis. So they looked at, they found what I just described. They found that both of these proxies, behavioral and risk-based, produce similar results. So what they did that was really interesting and unique is that they ran cross-sectional regressions on these global stock returns that they'd been looking at. So they went and reproduced, value as defined by book to market, which is the risk-based factor, versus sales growth versus past stock returns. These all give you similar results in terms of a premium. So then they ran a cross-sectional regression, and they added in a couple of other factors like market beta and size. Cross-sectional regression, the simplest way that I can describe it based on reading the paper is that they're controlling for each of the factors for each month of this regression to see where the premium is actually coming from. So in other words, if we control for book to market, are the behavioral factors adding any value? If we control for the behavioral factors, is book to market adding any value? And what they found, and to me this is pretty profound and meaningful, they found that if you control for book to market, the other factors, including the behavioral factors, add zero explanatory power.
Wow.
They add nothing. They're not driving returns. And then if you go the other way, if you control for a behavioral factor, book to market is still the one that is explaining the returns.
It's the one that's driving returns.
Yeah.
Which is the risk-based story.
The biggest drivers were momentum and book to market in their cross-sectional regression. So that, I mean, nothing's conclusive, I guess. These are all models and they're all hypotheses and estimates and whatever you want to call them. But this analysis, to me, was profound, like I said, because they really showed using this cross-sectional regression that book to market, which is the risk-based factor, that is the one that is driving returns. It's not the other ones. The other ones just happen to be proxies for the risk-based factor.
Yeah, and the quote that you have here is quite powerful. Based on these findings, we conclude that the empirical support for the overreaction hypothesis is quite weak.
Yeah, I think the first part of that quote is pretty cool too. They do a better job describing their analysis than I just tried to. But they said if we disentangle the contribution to return of various factors, valuation is significant while the overreaction indicators are not, indicating that valuation ratios are really driving differences in future stock returns. And then the quote finishes like you just described it. I hadn't seen this paper before, but I don't know how you argue with that.
So to take it full circle, it gives credence to the fact that it is a risk-based story. Therefore, you would expect it to persist. And we've just gone through a weak decade. And it should go back to having a positive expected return.
Yep. And you always have to go, I think it was in one of these papers, it was talking about Bayesian thinking, which I know we've talked about on the podcast before, but it's just that idea that humans tend to overreact to recent information. So we've had this recent decade of value underperforming, so people start thinking, well, maybe value is not so good.
So you're saying there's going to be behavioral overreaction to something that's risk-based?
No, I'm saying that...
I'm joking. The investors are going to be overreacting to the fact that value has delivered a premium.
Yes.
I was trying to be funny in a nerdy kind of way, I guess.
Your facial expression was so blank. I didn't know you were trying to be funny. There you go. Anyway, so one of the things that we can't definitively say, although I think this paper got somewhat close, we can never definitively say that it's a risk-based explanation or a behavioral explanation. We can't assume investors are perfectly rational. There's no way to do that. But this paper, the way they did the cross-sectional regression to show what was driving returns, to me, that's as compelling as it gets.
All I know is we had a similar period back in the late 90s, and a lot of people lost their faith on value, and things turned around. I think we had the data a couple of weeks ago showing how fast this can turn around, and you have to keep the faith. Well,
there was the data that you're talking about is March 2000, I think, versus March 2001, where if you looked, and those dates may be imprecise, but if you looked at the value premium for every time period, 1, 5, 10, 20-year period, ending March 2000, I believe, value is negative every single period. And you shift forward 1 year to March 2001, not 1 year where the value premium was negative.
So on to our planning topic.
Yep.
Good to go. So question we get a lot is, when should I take my CPP, my Canada Pension Plan? So it comes up very often. And it's something we're going to be doing a lot more work on. But today we wanted to kind of go over the basics and give some rules of thumb and some of our thoughts around this. So the basics on CPP, so it's a Canada Pension Plan, like we described in item number 1 today. So the contribution rate for people now is 10.2%. So half matched, half by you, half by your employer. If you're self-employed, you pay the full 10.2%. But when to take it, because you can take it as early as age 60, the normal age is 65, or you can take it as late as age 70. There's no benefit to deferring it past age 70.
Can you defer it? I guess they never make you take it, do they? You have to apply for it.
But I mean, it doesn't benefit doesn't increase. So if normal age is 65. If you take it earlier, it's reduced by 0.6% per month, so 7.2% per year. So if you take it at age 60, it's 36% reduction. So the maximum benefit, if you're taking it at age 60, is $738 a month.
$738
a month if you qualify for the maximum.
I think we should just real quick, I'll let you continue with this thought, but the contribution rates, you mentioned that they'd gone up a little bit, and they're actually going up every year for the next few years until 2023. Yeah. So there's an increase this year, there's an increase next year, and each year up until 2023. And then after that, they're actually adding an additional enhancement above the yearly maximum pensionable earnings. So right now, do you know what the YMP is this year? 57,000 or something like that?
It's in that range.
So if you pay into CPP and your employer matches on your first roughly $57,000 of income, whatever the yearly maximum pensionable earnings is in that year, and as of now, in excess of that, you don't continue contributing. So if you're making $114,000 a year, you will notice that halfway through the year, your paychecks go up. Yep. And that's because you've maxed out CPP. And what they're doing after 2023, so they're increasing the contributions on that base amount on the yearly maximum pensionable earnings. And then post 2023, they're also doing an additional enhancement. So there will be more contributions above the yearly maximum pensionable earnings.
So it becomes a bigger deal in retirement planning. It'll be bigger numbers, bigger contributions, and it's complicated. It's really complicated. So if you take it later than 65, the benefit goes up by 0.7% per month. So 8.4% per year. So to a maximum 42% increase at age 70. So the maximum you can get at age 70 is $1,638 a month. So the obvious question is, do I take it early at $738 or take it later at $1,638 per month?
Keeping in mind that if you're taking it at 60, there's 10 years where you're not getting any benefit.
Right.
Or sorry, if you take it at 70, you're foregoing the 10 years of benefit that you could have had by taking it at age 60.
Yeah, although it's less than half, you're getting it 10 years earlier. Here's some interesting data. I picked this up today. So 312,000 people who started CPP in 2016, 126,000 did so at age 60. 93,000 started at the normal age 65, and only 4,800 out of the 300,000 people waited to age 70. So clearly people are taking it when they can.
That is interesting. Because the statistically only, not necessarily optimal in every case, which we're going to talk more about, but the statistically optimal thing to do generally would be to wait until 70.
Yeah, if you have a normal life expectancy. So right now, a man age 60 can expect to live another 23 years to age 83. And the crossover, depending on the rates of return that you assume, is somewhere in the mid-70s. So if you're going to live beyond age 70, you're better off to wait. So statistically speaking, you're better off to wait. There's
some other interesting stuff in there too. Like I know something that a few people have written about in the past is that if your expected returns are really high, then you're better off taking it earlier and investing.
Absolutely.
But how many retired people have really high expected returns? Probably not many. But it is an interesting component.
And the other one I read about too is, I think it was Rob Engen talked about this, is that if you're going to have a large RIF balance when you turn 71, start paying when you're 72, that might cause OAS clawback. You might be better to defer your CPP benefit and burn down your RSP earlier, therefore having smaller minimum RIF payments later on. So again, it's a very, kind of...
Oh, it's so case by case.
Case by case.
Because people do often ask us, when should I take CPP? As if there's a simple answer, but it's extremely case by case. And we'll often do one-off, because it's always one-off, but we'll often do one-off analysis to figure out for this individual situation based on all the other stuff that they have going on.
But it's also, what's your objective, right? Is to get the most money you possibly can? Or is it, as Rob pointed out in the article, is it about longevity insurance? Because if you have $1,638 a month and you happen to live to 100 years old, you might be very happy to have had that built into your plan.
But you can't guarantee how long you're going to live.
Well, that's just it. You're looking for long-term protection or the most amount of money as possible out. Then we started looking into dropout years, which is something we have to do more work on. But at age 65, you're able to drop off the 8 lowest income years. At age 60, it's roughly 7 of the lowest income years fall off in the calculation. So let's say, for example, you retire in your late 50s and you have no further income. The question becomes, well, should I take it at 60 because of the number of years that are going to drop off, or wait to 65? Well, again, that's a personal choice, because you have to go back and look at, did you have low income years early in your career or not? So it's very, very customized.
Yeah. Well, if you are in your contributory period until you're 65, then you can drop off your 8 lowest income years. Yep. So if you retire at 60, say you maxed out, so you have to have the 39 and a half years of max contributions to get the max, right?
I believe so, yeah.
And the way they define your 8 lowest income years, what's actually by month, your 96 lowest income months, the way that it must be by years. No, they state it by months though. Anyway.
No, it was by months in the table.
Yeah, okay. So the way that they calculate your lowest income periods of time is as a fraction of the yearly maximum pensionable earnings. It's not an absolute dollar amount. It's what percentage of the yearly maximum pensionable earnings did you make? And then they drop off the 8 lowest contributory years. So if you've worked 39 and a half years and you're 60, then delaying wouldn't have any effect because you've already got the 39 and a half to get the maximum benefit. And there's 5 years from 60 until 65. If you know you can drop off your 8 lowest years, if you don't contribute for those 5 years, those are going to be your lowest 5 years and they're going to drop off. But if you're 60 and you've already had 8
low years,
say no income years,
then you may want to start your CPP right away.
Then you might want to start your CPP earlier. So there are definitely some tricks and snags that can be pretty tough to understand when it comes to when to take CPP. Another one that I find interesting is if you are taking CPP and you die, the survivor benefit to your spouse, assuming that they're over the age of 65, is 60% of the benefit that you were receiving, but up to the maximum benefit that they could be receiving.
Correct.
Which is another tricky aspect.
So you have to look at the health of both spouses then, perhaps.
If your spouse is already getting the maximum CPP benefit and you die, they will get nothing in addition to what they were getting before. Like there is no survivor benefit if your spouse is already getting the max that they could be getting.
Exactly.
It's not so easy to understand, and it's so case by case. Like just that last thing we were talking about the drop off, you got to know for that individual person how many low income years or no income years do they have, and that informs when it makes sense to take CPP.
And so many people say, "Well, I'm at the maximum. I've been at the maximum forever," but the average payment is well below the maximum.
It's like half.
What's the average? I think it is about half.
$600 something. I haven't looked at it in a while, but it's roughly half.
Anyways, fascinating topic. Lots of work to do there. Anything else?
No, I think that's good for this. We didn't have a worst advice, but I think that PBO report on the CPPIB, that was pretty bad advice because they're basically saying, look, active management works, which I wouldn't call that good advice.
All right. See you next week.